thanks very much for that, and it's great to be here. I guess I'm kind of different from the last two. The last two were very macro and certainly the two largest economies in the world, but I guess there's one thing in common I can have with Katie's, which hopefully I'm here to talk about a high-quality company at reasonable value. So if only we were in the US, we'd actually qualify to be in her fund, but we're not. So if I can move on to the slide. So I'm going to say a few things, first of all, because I'm not sure everyone would necessarily know who we are. So Serica Energy is a UK listed, we're listed on the AIM market. We're today about a market cap of £600 million. And we're an oil and gas producer, very much a producer. We're really not an explorer. I mean, the term tends to be used E&P, but we're very much a P producing company. We produced, at the end of last year, 34,600 barrels of oil equivalent per day. And that's split almost 50-50 between oil and gas. The company's been formed, and that's very much the strategy of what we do, by buying assets from larger companies, so from BP, Shell, and Exxon. So we produce gas out of that hub in the north there. You can see the Bruce hub, and then we produce oil essentially out of the Triton area, which is, you can see that little picture of a ship further down on the map. So we're producing about 5% of the UK's gas production today, and I guess people will have seen in the news that's been quite topical. The UK's pretty short on gas supply, and so, you know, even a company of our size, we're still quite a material part of that and an important key part of the energy supply for the country. What we also like to do is we don't just buy assets and kind of run them hopefully leaner and meaner than the previous owners, but we also invest in those assets and unlock opportunity within the subsurface. So we're going after things that the previous owners just wouldn't allocate the capital to. They became less core to them, so it makes sense for us. We've got very high quality people who can unlock that value, and we're doing that, and I'll talk a little bit more about that as we go through. And then finally, I'd say that possibly what differentiates us versus some of our peers, we've got a very conservative balance sheet. We're usually running about net cash. We've just given our trading statement today, so we're actually, at the year end, will be net debt of $71 million, but essentially we'll turn back into cash quite quickly because we're seeing a year of very strong cash flow generation coming through. And the other component, which I'll talk a bit more about, is the tax position that we have. And we're in a basin, we're in a market where tax is really as important as everything else. We're taxed, you know, it's hard to believe, at 78% being the marginal tax rate. And that meant, frankly, last year it was incredibly difficult for us to talk to investors about coming into the story. But where we've got to now is, of course, we've got a new government, we've got a 78% tax rate, and I think we would contend that the risk of it getting any worse is essentially gone away, right? The risk on tax is probably more to the upside now rather than the downside, partially because there are only 22% left. But you know, the reality is it's probably harder to see that the tax position gets worse. So we think that the position has reached a point now where, you know, we can certainly tell a story on a go-forward basis. We think we've got a nice organic story, and then there's some macro trends that we can obviously comment on. So we just put this out this morning, and one of the things we had to tell was the story about our own performance during the year. So one thing we are doing is we're managing mid to late life assets in the North Sea. The North Sea is not an easy place to operate, right? It's a relatively hostile environment, and things do happen offshore. So we had, as you can see from this chart, we basically have three main hubs, and we've split it in those colors to kind of indicate two hubs, and then we have some non-op assets on the top, the gray bar. And you can see our production on a kind of month-by-month basis. One thing to sort of get your eye on is we always, and like all our companies in our space, will have a summer period where we have less production. That's because we schedule annual maintenance during that period. So we get shutdown periods. Obviously, the weather's better, so it's a better time to be doing maintenance when you have to get people offshore and know that things can always happen. And normally, we'd have seen a good pickup in Q4, but we had some operational issues with one of our assets, the Triton, the FPSO, and that hit us in the fourth quarter. So we actually ended up missing our production guidance and came in at 34,600. But the good news is that we've spent the time and we fixed that issue, and we really understood the issue, and we took the time to fix it. So we're coming into 2025 in a much better place and seeing a really good trajectory for this year. So this again just talks about how we generated cash last year, and I think our revenue came in at $726 million. That was down quite a lot on where we should have been, basically because we missed the production in the fourth quarter. So I mentioned that we ended the year at $71 million of net debt. We've also calculated that had we not had the issues just in Q4 that we did have, we'd have been net cash at the end of the year. So effectively, we lost at least 70 million just through the last quarter by the production that didn't come through. The good news, of course, is we haven't actually lost that production. We've just deferred it, and we've deferred it into this year. And actually, in the meantime, the oil price has gone up. So we'll actually be producing it into a better market than we were in the last quarter of last year. But what we did during the year is we've also been investing heavily in our portfolio, and that's very much what we're about. Our operating costs are essentially quite fixed. CapEx can be variable, and we've been doing a high amount of investment, actually one of the highest probably of anyone out in the basin at the moment, which is reinvesting back in our assets, and we can actually deliver very robust returns, and I'll talk a little bit more about that in the current environment. But at the same time, because we recognise that in the sector that we're in, really the generation of cash and yield is so key, we've continued to reward investors through both a strong dividend and also last year through a modest buyback. And we were able to do that because we have a very strong balance sheet, right? So we have a resilient, strong balance sheet. So notwithstanding the fact that last year we actually had essentially cash outflows overall, we were able to continue to pay a robust dividend, and we saw the strength in our portfolio, and we'll see that come back this year with what we expect to be a robust cash flow performance and continued reward to shareholders through distributions. So this chart talks a little bit about our guidance, because one of the key things people focus on is how much production are we going to put out. And you might think that was an easy thing to say. It's not easy, because we guide to what it will end up being after we take an account of things that we know will happen, i.e. maintenance periods, but also things that we don't know will happen. So we have to cater for the kind of known unknowns and try and factor those in to an overall average daily production level. So we've guided this year to 40,000 barrels of oil equivalent per day. And the reason we put that chart in, which you can see there, is actually on a quarterly basis back over the last 2 years. And you can see that the 40,000 that we've guided to for this year is something like 15% higher than we achieved in 2024, but it's bang on what we achieved in 2023. And you can see, though, that 2023 really is a good illustration of what the quarterly pattern ought to look like. A reasonably strong Q1, a Q2 was good, Q3, summer maintenance period, so lower production, and then Q4 it comes straight back again. And you can see that in 24 that didn't happen, and that's what we missed. So this year, because we've fixed the issues that we faced, we'd expect to see something that looks in shape much more like 2023. And at the same time, we've got some new wells that we've drilled and that we think are going to come in really well. And so in that forecast of 40,000 barrels of oil equivalent per day, we've included what we call the P90 production profiles for new wells that we've just brought in. So P90 means the 90% confidence interval of what we're actually going to get in terms of production. So the two new wells that we've drilled, and they've been really, really good and successful wells, called B6 and GEO5. We drilled them during 24, so we spent all the money in 2024, but we really didn't get any production from them in 2024 because they tie into Triton, and Triton was offline for large parts of Q4. So the production's only really starting now. So the production will all come through right now. But actually, the rates at which they've been producing are substantially better than the P90 and probably better than the P50 case. So they're producing very well. In particular, GEO5, the well we most recently brought on, and we only announced today the flow rate, that single well tested at 9,000 barrels of oil per day. On a stabilized level, that would be more like 6,000 barrels of oil equivalent per day. Sorry, barrels of oil per day, because it is all oil. But actually, we're still carrying numbers in our forecast which are actually quite a lot below that on a long-term period for the year. And I think one thing to point out there is when you bring in new wells, they actually do decline really quite steeply in the first year. And overall, we get a decline rate across our portfolio of about 15%. So we're constantly running to stand still, which is an important thing for people to appreciate. We have to keep, the only way we're going to stop the production rate declining is by drilling new wells or, of course, by doing M&A. And I'll talk a bit more about M&A as well in a minute. So the other factor that goes into our production forecast is uptime. So built into that 40,000 barrels is the fact that we would be having essentially 80% of the time, other than our scheduled maintenance times, we would be running. So effectively, we've got 20% of non-producing time, and that basically deals with the kind of known unknowns, that we will have some things that occur that means we're not always producing exactly at that level. But we think it's a pretty balanced and actually conservative set of assumptions that have gone into that. So upside from better production, but even with that production, we will see a strong performance of cash flow relative to 2024. So, we think there's a lot to go for there. The other thing we're doing is we're taking the opportunity this year, and I'll talk a little bit more about CapEx, to make investments in the assets, not just to drill new wells, but also to improve resilience, because the issues we've faced over the last year have been things that we know we can make investments to avoid happening again. So we're making investments to improve the resilience of the assets. This talks about CapEx. So we guided again today for the first time our CapEx for the year at 220 to 250. We spent 260 million in 2024. So you can see relatively heavy amounts of investment. About 70% of that is going on the well program that we're in the middle of. So we're halfway through an extensive drilling program, and as I say, we're probably one of the most active drillers in the basin right now. So about 70% of that was things that we'd already committed prior to the year beginning. But then we brought forward that the grey sort of part of that circle there is about $50 million of projects which are resilience type investments. And we actually, because we set our actual budget after the country's budget on the 30th of October, and we were watching that budget like a hawk, as was the entire industry. As everyone probably knows, we ended up becoming a political football in terms of the tax rates, etc. So we ended up with a 78% tax rate, insane, and I'm going to certainly take questions on that, but we did. But one of the things that we were also threatened with was that the government would remove capital allowances, and that sounds like a piece of arcane bit of sort of tax mumbo jumbo, but it really matters. The campaigning of the Labour Party was around putting the tax up to 78% and removing what they called unjustifiably generous investment allowances. And at one point we thought that we would be taxed at 78%, but only get capital relief at 46.25%. And if that had been the case, we basically wouldn't have been able to make any investments at all in the assets, and not just us, the entire basin. So fortunately, the entire industry, everybody spoke with one voice and talked to the government at all sorts of levels, obviously from Rachel Reeves down. And in the budget, the government, to their credit, retained what's called first-year allowances. So essentially, that means we're treated the same as all other industries in the UK in that we get full expensing for capital. The only difference is the rest of the economy is taxed at 25%, we're taxed at 78%. But we do get to relieve at 78%. Actually, technically, it's slightly more at 84.25. So what that means is we, as a reaction to that, is we brought forward about $50 million of spend that we just otherwise wouldn't have spent because we can get that relief. So we're able to invest now and build resilience into our assets because of that move. And one thing that the country probably needs to understand is, what is that investment? That investment is us investing in businesses in the supply chain, almost all of which are in the UK, which means that investment equals economic growth for the country. Far more than it does if you're investing in solar panels or wind, because that's almost always outside of the country. So we have, in our industry, because we've been producing in the North Sea since the 70s, we have a very well-established supply chain in the UK, world-leading businesses. And so our investment equals economic growth. One of the other things we're doing is it's a relatively small investment, but we're investing $10 million in what's called a flare gas recovery project. That is, probably as the name suggests, it's a way of us capturing some of the gas that would otherwise be flared. We have to have a flare for safety reasons in any event. In certain circumstances, we have to flare gas. We don't do routine flaring. but we can actually make that more efficient through a bit of investment, and it's $10 million, and actually that gets an even more attractive tax treatment. So that, because the government retained what's called the decarbonisation allowance, we actually get 109% relief on that. So what that means is that is all being paid for by Rachel Reeves. So that one's a really good investment. It's essentially allows us to invest on that basis, but at the same time, it improves our emissions performance, and because we flare less gas, we can sell more gas. So it's a kind of multi-win investment. The only problem is the decarbonisation allowance rules are set so tightly that that was literally the only thing we could find in our whole portfolio that actually qualified. So, the government will trumpet that they retained the decarbonisation allowance, but they set the rules on how you can use it incredibly narrowly. Finally, we've got some projects in the longer term portfolio, which at the moment we're spending very little money at all. They are just that kind of grey, little tiny grey bit that we're spending on kind of pre-costs. And one of them is a project which we call Buck and Horst, which is actually a redevelopment of an oil field that used to be run by Repsol, and they ended up having to. It had an FPSO on it, but the FPSO became too old that it was effectively unsafe to run. So they had to take the FPSO off, but they left a whole bunch of oil in the ground because they didn't finish producing because it had run out of oil. They finished producing because the vessel was unsafe. So we're in that project now together with two other companies, Neo Energy, which is a private company, and Jersey Oil and Gas, who some of you may know. And that is a project that we had been trying to bring to sanction before the general election in 2024. However, at the time, we were working to the expectation that the general election would have been in the autumn, and as of course everyone knows, it got moved to July. So we were unable to get that project through before the general election happened. So now we're in a position where that project is effectively on a sort of care and maintenance, because we are not going to spend serious money on investing on that, and that would be, that project is well over $1 billion of investment overall. It would create well over 1,000 jobs across the UK, well-paid jobs. It would certainly drive economic growth, virtually all of the supply chains in the UK. But we're not going to spend a cent on that until we have the right regulatory and fiscal regime. So to give credit to the government, they came in with a bunch of kind of soundbite policies. Since July the 4th, they have been turning the soundbites into reality. And they have been, and they are, consulting with the industry. So there are currently 3 consultations ongoing. One is on basically what the tax rate will be after 2030. So the so-called EPL, the Energy Profits Levy, is in place until 2030, but the government is consulting on what will replace that. And they're also consulting now on that because even though the 78% tax rate is there is actually a mechanic which says if the oil or gas price goes below a certain level, it falls away. So they need to know what it's going to fall away to. So there's a consultation on what the long-term tax regime for the UK CS will be. There's another consultation on how to get environmental impact assessments done to allow new projects to happen. And finally, there's a consultation on new licensing. So this year, we're going to see, probably they say by the spring, they haven't quite defined what spring means. I don't think we're talking when the daffodils are up. We're probably more talking, when we're into, let's say, I don't know, roses probably more like, right? I mean, than daffodils. So, but by the spring, we should have a bit of a better picture from this government about what they're going to do in terms of the overall regime for the UKCS. And that will be key not just to what we've got, but to a whole slew of other projects that are out there waiting. And, shovel-ready projects that the country could get after right now and drive economic growth. Just need the policy background to allow it to happen. So this sets out, notwithstanding what I said, this is our forward program on things we are already doing and are committed to. And these projects we're doing, they're all really what we call short cycles. So Gannet E and the Bittern well, which isn't even on this because we drilled it last year, those two, because we've already drilled them and we now know exactly what they're doing, we've done the calculations, and the payback on those is those 2 well investment costs will pay back by the middle of this year. And they'll carry on producing for several years, more than that, right? So the payback is super quick. They're well over 100% IRR. So these are really short cycle, little infill things. We're not taking massive political risk on this, right? Because the whole thing is we know exactly what's happening within that time frame. We're not taking investment decisions which go on, because obviously some of the big projects that you may have heard of, the Rosebanks, Cambos, those are 30-year type investments, right, that companies need to make. These are very, very different, short cycle, infill, but really high return. And then we've got more of the same in Evelyn, and then the Belinda project, which is actually Belinda has a pretty interesting component to it. It actually has the perhaps dubious honour of being the last project that the government has actually approved for development, because that one, we got our development consent just before the July election, and no other project has been approved since, because essentially we're in a period of abeyance until the government decides what the new regime's going to be. So we certainly hope we won't keep the honour of being the last FDP for much longer, but that one actually is it. So finally, that just looks at our guidance for the year as a whole, and I think a couple of other things just to maybe highlight here. One of the reasons why we think the cash flow will be strong this year is we also had some hedges, which were what we call legacy hedges. They were actually capping our oil price in the low 60s for much of last year. Those hedges are now rolled off, so they were volumetrically based, and we've just done the last lifting that's taken them away. So we'll now actually be getting exposure to the current oil price and the current gas price, both of which are quite robust. And so that will certainly help to, and the better performance on production, which should help to deliver a very strong cash flow performance this year. We've kept CapEx a little bit lower, OpEx essentially the same, but better production and better realized prices will lead to better cash flow. And to give people a feel for the kind of exposure to the commodity, about every $1 a barrel relative to our $75 planning case represents $2 million of free cash flow, and every 1 pence a therm relative to our 82.5 planning case is about 1 million. We're more leveraged to oil only because our oil production is essentially tax-free, because we've got $1 billion of tax losses, which actually only attached to our oil production, and that's where we're doing the investments, so we get capital relief against the EPL. So we have a better tax position in oil than we do in gas. I think that's it, and I can take questions on.
Martin, thank you very much indeed. Thank you. Okay. If you have a question, please raise your hand. First at the back, please.
So you mentioned M&A, and you mentioned 78% tax rate. Where is this M&A going to be? Is it going to be in the North Sea, or is it going to be in more stable jurisdiction like West Africa, for example?
Yeah, that's a really good question, and you're absolutely right. I mean, I make the comment to people that the UK is really I made the comment to some investors that, we had to deal with our emerging markets government, and when I did say that to one investor, he said, that's far too rude on emerging markets. It's essentially a frontier market. So, no, but the thing about the UK, and it may seem odd, but actually, pretty much since about the middle of the year, we were looking heavily towards Norway. Norway's kind of attractive in many ways. It's a 78% tax rate, but it's been 78% forever. And that's, by the way, the reason why the Labour Party picked 78. They said because it's what Norway's got. But they've had it forever, which means it's going to be that way. It's planned that way. You completely understand it. Plus, it's a much younger basin. I mean, other interesting stats is the Norwegians just announced last week that they've just awarded 53 licenses. We're having a debate about whether we should award any licenses. And this is our neighbour just across the water, right? I mean, our platform is 15 kilometres from the Norwegian border in the sea. So, it's not very far away, right? Anyway, having said that, our focus actually has come back to the UK. And it may seem odd, but from an M&A dynamics, the problem with Norway is we like a lot about Norway, but so does everyone else. We're not the first people to spot that, which means buying there for value is really quite hard. The UK is the exact opposite, right? Everybody who's here, I mean, you've probably seen Apache announcing that they're going to be leaving, and Donald Trump tweeting about it and all this kind of stuff. Basically, everyone who's here and all the big guys want out. So the opportunity from an M&A perspective is actually quite significant. So we really see an opportunity actually to be doing more and consolidating in the UK. It's not to say that we aren't looking at other places. We are looking at other places, and I think I described it earlier today. We want to find kind of Goldilocks places which are the right exposure to political risk, the right kind of maturity of assets, and ideally places where society is understanding the reality of hydrocarbons and their continued usage, and doesn't sort of drive policy in a direction which unfortunately has happened a bit here in the UK.
And I think the gentleman here with the brown jacket, Steve, and then we'll come over here. Thank you.
Hi, great. Thanks for the presentation. I'm just Can I just ask you, you've sort of given us a picture of 12 months, and I'm actually a holder of Serica.
Yeah.
Great company. But I don't understand what is it. Can you give us a more medium-term projection, and also what resources out there within that North Sea area that are available for Serica?
Yeah, well, look, we specifically haven't guided beyond 2025, right? So partly that's why I'm talking about this year, because we've just given our guidance for this year, and we're not guiding for another year. But equally, you'll have seen that, say, Belinda, which we're spending money on, won't actually produce at all until 2026. So we think we can keep, and I also made the point that we have to kind of run to stand still. So we're investing to try and keep that roughly at the same level. But we can't do that forever, right? We run out of things. So if we sit there and do nothing, the whole portfolio declines at 15% per annum, right? And so if we sit there and do nothing, that's what will happen. We won't sit there and do nothing, clearly, right? We'll either reinvest and or buy things, right? Because we know that that's how it works, right? And so we'll constantly be trying to replace at a level better than our cost of capital, essentially, so that we can create value. I mean, that's fundamentally what we're trying to do as a management team. So I can't really say more than that. We did put a slide out in our interims. I don't think we've updated it, but we showed that on a cash flow basis over 3 years, we would generate easily our market cap, right? And the other point that's probably worth mentioning is we don't have a wall of liability that sits out there beyond that, right? So a number of companies and of our peers maybe have got a lot of decommissioning spend that sits in the period sort of beyond that. We don't, and it's not because our assets don't have decommissioning. It's just that we bought them through M&A, and as part of that, we left the decommissioning liability behind with BP, Shell, and Exxon. So it's just through M&A transaction structuring that we've achieved that.
Okay, question here, please. Thank you.
I've got two questions, if that's all right. I was on the Investor Meet Company presentation this morning, and your CEO gave a very interesting answer to the last question, where he, I don't know how you would describe it, but I think sort of speculated about becoming the biggest producer in the North Sea.
Yeah.
Can you just quantify what that means?
Yeah, I should have a slide, shouldn't I, on that? But I mean, I liked his ambition, and as I think you may have heard, I did make the comment that on the day after the inauguration, it was a question of making Serica great again. But
I did.
But look, I mean, for us to become the largest producer in the North Sea in one go is clearly a bit of a tall order. However, it's not inconceivable in the context of several moves, right, of a chessboard. So I think to have it as an ambition in a world where there is going to be, and there already has been, quite significant reshaping of the basin. So, just before Christmas, Shell and Equinor decided to announce to put their business together. There's a lot of, effectively, the way I think about it, I mean, I was an M&A practitioner for 30 years, right? So that's what I've done all my career in the oil and gas sector. But what we're seeing right now is a bit of a game of musical chairs going on, right? So everybody's kind of talking to everybody, and there's all sorts of things that could happen. We intend to be part of that, and we intend that when the music stops, we have a chair.
But to be the biggest producer, would you be doubling your size?
Oh, much more than that, right? Yeah. I mean, if you say, so like Harbour Energy is producing something like just under 200,000 barrels a day today.
So 5 times.
Yeah.
And the second question, am I right in thinking you don't hedge anymore?
No, we absolutely hedge.
You do?
So, in fact, I've got a slide, I think, if it's in here. Is it in here? No, yeah, it's probably after that one. There it is. So, yeah, that tells you what we've got hedged. So, we do hedge because we've got a reserve-based lending facility, which is a debt facility, and in fact, the banks require you to hedge. But actually, we think this is actually a prudent basis of hedging. But the main point, as I was making for this year, is we've rolled off these ones. This 6, which we're calling swaps, but actually that was a fixed price contract. That was at relatively low. It was like low $60s a barrel. That's rolling off. And then the new hedges we've got in oil, you can see we've done them predominantly through an instrument called a collar, where we basically have a window within which we can, we cap the upside, but we protect the downside. And the range is, you can see on oil, we've got it between a floors of around $70 and then upside, though, all the way to $96 in the first quarter and then in the high 80s through the remainder of the year. And you can see the same equivalents on gas, right, over there. So, and overall, we're hedged about, 2025, we're hedged 30% overall, slightly more in oil than in gas, and a little bit less for 26. And we'll keep we'll keep updating this program. So on a rolling basis, we'll always be hedged about that amount for the next rolling 18 to 24 months. But what we want to do is make sure we'll never, we will generally not hedge significantly more than that, partially because we think our investors quite often want to get the exposure to the commodity price, right? So we don't want to over-hedge, but we want to make sure we protect the downside, and particularly in a period when we're making quite high investment. So we should be, protecting the downside.
Okay. Thanks.
Question here, please. Well, pass it forward. Thank you.
You said that your current oil production is almost tax-free because you are utilising the accumulated tax losses on the balance sheet as relief against CPI.
Yeah, maybe I should elaborate on that a bit more. Yeah.
Well,
Go on.
Could you please elaborate? Could you say, at the current run rate, how long does that position last?
Sure. So we have, we just disclosed today that we've got about $1 billion of tax losses, and the way tax losses operate is they're obviously, they're tied to specific subsidiaries that have the losses, right? So they're company specific, and it just happens that our losses sit in the entities that own our Triton assets, which is our oil production, right? So it's not that, it just happens that the losses sit in the entities that produce the oil rather than the other way around, whereas our gas, the entity that owns that doesn't have any losses, so it's paying the full tax rate. The one thing to bear in mind is that when they introduced the egregious energy profits levy, one of the things they also did, and the reason they called it a levy and not a tax, is that they said that you can't use losses against it. So we can only use losses against the corporation tax and the supplementary corporation tax. So the 40% level that we pay relative to the rest of the economy pays 25%, we pay 40%. We can only use losses against the 40%. So ordinarily, we would still be paying another 38% of tax, right? But the difference between 40 and 78. But what we can do is invest. And so that's why I said it's relatively low, almost tax-free. It's not completely tax-free. But because we are investing heavily again in our oil assets, we're getting capital relief at 84.25% on every dollar that we spend. And that relieves some of the EPL, some of the levy amount, right? So that can't go on forever, right? Because if we stop investing, we'll have to pay the 38% tax. And you asked the question about how long the losses last. Of course, it's a function of how much we produce and what the oil price is. So it's not always, and in fact, we didn't use nearly as much as we thought we would last year, because one of the benefits of not producing so much is we didn't use the losses so much, right? So they'll last a bit longer, right? We usually say 2 to 3 years. I suspect it's a good 3 years now, right, of life left in them. I mean, actually, we just did a transaction before Christmas, a small transaction. We're buying Parkmead E&P, which was really consolidating an existing asset I didn't really talk about called Skerryvore that we own, and picked up another license. But we also got an additional $250 million of losses that will just help to add to our loss pool.
And we are slightly over time, but there's one final question. If you have the microphone still, please, Chris. Thank you. Sorry, Steve. Thank you.
Can I just test my maths, please? So 2024, you had specific circumstances that reduced production. You're looking to return in 2025 to the 40,000 that you had in 2023. And you've got a new Gannet well coming on at the start of the year, which you're expecting to deliver 6,000 barrels. But you've given us a decline figure of 15%, which neatly happens to be 6,000 from that 2023. And by my maths, that would decline by a further 5,000 barrels in 2025 if it's an annualized 15%. So you're hoping, because you've got other assets coming on stream later in the year, but the rosy picture painted by the high performance of Gannet is actually required to hit your target, not a bonus on top of it.
No, okay, so actually that's relatively easy to answer, actually. But firstly, because what I didn't say is that the decline of 15% is off the capacity of our wells, which is more like 50,000 barrels, right, already. So you start by that, right, and that is the first point. So you've got to go from 50,000 capacity, take it off from there, and that infill is beginning to. It's true that we need Gannet and B6 and these other things to stop the number reducing, but we don't need it to do better than we did for the 34.6 that we did in 24, because that was basically because we just had periods of time when we weren't producing, right? So I think when you actually take into account, you've also got to take in all the uptime assumptions that we've got in there as well, right? That's why it's always tricky, because we guide on what is the average daily rate. Well, it's not going to be like that, right? We're going to have high production in the first quarter, and then it's going to be coming down, partially through natural decline. So that Gannet well will probably decline at about 50% in the first year, right? But then we're also layering in B6. We've also got Guillemot well that's coming on. We've got Evelyn 2 coming on. So all these things, they're only in at my P90 forecast. And all of that effectively gets us to the 40,000. So I could go through it offline, probably. It might be better to do that.
I think we're getting into the details. Are you going to join us for a drink now, Martin? Are you going to stick around?
Sorry?
You joining us for a
Yeah,
drink?
sure.
Okay, well, come and join us for a glass of wine. Thank you very much for coming. Thanks for the presentation.